Now is Essel Propack. It's actually been a stock that has bucked the falling trend in the market. So if you look at the last 3 months chart, the stock has given you 20% returns. It has gained about 20% in this year as well, year to date. So it's not been a bad performance by Essel Propack. Ashok Goel, the Vice Chairman and Managing Director of the company, joins us now to talk about the way forward. Mr. Goel, good morning. Thanks for joining us. Just for the benefit of our viewers, the company manufactures laminated plastic tubes for a variety of sectors, including FMCG and pharma. It also now has gotten into making tubes for cosmetic products and supplies to the likes of L'Oreal, etc. Mr. Goel, in the quarter gone by, your demand was very subdued. Your growth in income was just about 5% odd. Has there been any improvement in demand at all?
See, for Essel Propack, demand doesn't really have a direct correlation with how the FMCG sector itself is tracking. And I'll tell you why. It's because of our non-oral care strategy. That means that we started to cater to beauty and cosmetics, pharmaceuticals, foods and home care products, which essentially means that we are changing from existing packaging format to laminated tube format. And therefore we are gaining a lot of traction across the globe in almost all geographies that we operate in. That's number one. Number two, you have to also factor in that we have a price pass-through of the raw materials to the customers, and therefore you would see my revenue numbers will be little subdued as compared to last year because the raw material prices are falling.
Okay, but what is the percentage of revenues that come from cosmetics, from pharma, and basically non-oral?
Yeah, so that's a great point. For non-oral care, when we started this initiative a couple of years ago, we were just 10% of our non-oral care revenues that were coming from non-oral care. Today we are at 43.3%. And our target is by end of next year, we should get to 50%.
No, but how much of this is pharmaceuticals? No, I'll tell you why. Because ultimately, while FMCG is dependent on consumption demand and the growth of the economy, to some extent, food and cosmetics also will be. So, Sonia's question is still very relevant. Maybe pharmaceutical is defensive and demand will come regardless of the business cycle. But for the rest of the products, the business cycle will hit. So basically, are you seeing a growth in demand?
See, for us, the demand is not directly again linked to how the FMCG sector is doing. It's primarily because we are changing the existing packaging format. For example, for pharma, it is from aluminum tubes to laminated tubes. For beauty and cosmetics, we are changing a lot of plastic tubes and bottles into laminated tubes. In case of foods, we are changing from bottles to tubes. So therefore, it's not necessarily the sector growth is helping me to grow. It is the change of format of packaging that is also helping me.
So how should I gauge your volume growth, say? If you say revenues will be lower because of raw material, how is volume growing?
Volume is growing in all geographies. For example,
does it grow by 10%, 20%?
Different geographies are growing at different rate.
Overall?
Overall, we are growing at about 12%.
Okay, but the geography which is, called the AMESA region, Africa, Middle East, Egypt, that has seen a revenue slowdown in the last quarter. Are you facing some pressure over there?
In India, it is first of all, the new product categories within FMCG which are getting introduced, like the BB cream, the CC cream, all that we are capturing. So there is a growth that is coming from new categories. Overall, FMCG sector may not be growing as much as you think it would want to, or we would want it to grow. So that is bringing in growth. And Africa, in AMESA, you particularly mentioning, is primarily because of the raw material price pass-through. That is showing you a depression of the revenue growth. But underlying growth in India particularly, because and India is part of AMESA, the volume growth is about 10 to 12%.
Okay, it's interesting you pointed out this BB cream and these new categories in cosmetics. So out of the 50% of non-oral care that you plan to, make as your contribution, how much of it will come from cosmetics?
We expect 50% by end of next year.
From cosmetics alone. And are the margins higher in the cosmetics business?
The sales price per tube is much higher. Therefore, it helps me to improve my return on capital employed. It is less capital intensive because I am able to produce high value product from the same equipments, and therefore it gives me better returns.
Okay, let us swerve away from revenue since there are too many caveats over there. What kind of an EBITDA growth are you looking at over FY16 and 17?
Great point, Lata. First of all, we divested our flexible packaging business, which was pulling my EBITDA as a percentage by 1.5%. So since we have sold that, and the underlying business of the tubes, that straight away gives me 1.5% growth. Plus, because of our better efficiencies and all the other initiatives that we have taken, we expect that our EBITDA margin growth altogether should be growing at about 2.6 or 3 percentage points.
So from the 18% level that is currently at, how much can we expect, say, by the end of FY17?
So our target is to cross 20%.
By the end of?
Next year.
And your margins?
The margins,
okay,
20% by the end.
Okay, and what were you saying about the EBITDA? I thought you were
EBITDA margins to exceed 20%.
No, what I meant was how much will EBITDA as a CAGR grow? Do you expect that to do much better? You said revenue is about 12%.
Yeah.
So EBITDA grows what, 15?
EBITDA grows at about, yes, about between 15 to 20%.
Okay. You do have a debt of almost 650 crores on your books. Any plans to bring down that debt anytime soon? And if yes, how?
See, we are not overly concerned about the debt because the respective debts are in respective balance sheets. What does that mean is that we have so many subsidiaries overseas. Those debts are sitting in respective balance sheets. They are being serviced. In India, we have the least amount of debt at this moment. Part of it was helped by the proceeds we got from sale of flexible packaging business. And therefore, all our ratios in terms of debt to EBITDA or debt to interest servicing ratio or DSCR ratios all have improved. And actually, our rating has also improved 1 notch point. So we are not overly concerned about debt.
Okay, but do you see it improving even further if you are bringing down your debt? I think you all went from A to AA minus on care. Do we see that improving further? Will there be more pare down of debt?
Yes, absolutely. Every year we do have a free cash flow of about 80 crore to 100 crores coming in after paying the dividends. So that should help us to reduce debt further.
All right.
Right, we'll leave it at that. Thank you for joining us, and all the best for the quarters to come. That's the word coming in from Essel Propack. They plan to grow their margins further to 20% by the end of FY17, and they have new businesses like supplying plastic tubes to and laminated tubes to cosmetics, which is the big growth driver for them. That's a wrap on Bazaar. We leave the markets absolutely flat. The Bank Nifty is under a tad bit of pressure, but traders only will take all of that forward.